let's continue in this inventory topic that we've talked about and are talking about. This is 3 Mondays in a row now that we've been together, and I've told you that we have the choice between perpetual procedures and periodic procedures. And you should know the distinction by now. But in case you forgot some things over break, remember that periodic was historically true, easiest, least costly, but didn't provide us up-to-date information all the time. We only knew the level of inventory periodically, occasionally. And technology allowed us to adopt perpetual inventory procedures in lots of industries that we weren't able to historically. Perpetual procedures have stimulus that keep up with increases and decreases in inventory at the time they occur, so that at any one point in time the computer has updated records. The computer always knows the amount that we have on hand. So I think I said that in general terms, but let's see it in words to be sure. Perpetual continuously discloses the inventory that we have on hand. When we, when we buy goods, we debit inventory. That's how inventory stays up to date all the time. You're to know that already. And what we've kind of ignored is the database that the computer keeps up with. In accounting, we call that a subsidiary ledger. We've tried to ignore that to keep things simple for you, but somebody ought to be inquisitive enough to ask how. How does the computer do all this? Well, we're not going to get into programming and all that stuff, but we need an awareness level to say that when we debit merchandise inventory, there ought to be some record of that in the computer that keeps up with those specific commodities. So that's what we're calling a subsidiary ledger. You're to remember from 2 weeks ago in class, not counting break, that it takes 2 entries to record a sale at the cash register. When we bleep an item at the cash register, we know that we're earning revenue, debit accounts receivable, credit sales, but we're also reducing the level of inventory. Every time we make an entry that affects inventory, we need to post it to this giant database in the computer. We need to update the computer records all the time. That's how perpetual works. So at any one point in time, not only do we know the level of inventory, but we also know cost of goods sold. It would be easy to assume that the computer's always right, and that's a fallacy. We need occasionally to update the computer records. Occasionally, at least once per year, we need to take inventory. We call it a physical inventory. Count the goods that are really there and change the computer records to agree with the truth, the goods that are really on hand. Now, think about that just a second. What about the shoplifter? Does the shoplifter go through the checkout line, walk by the cash register, and allow the good to be bleeped? Yes or no? No. Then there's no time for those computer records to be updated. We need to occasionally count the inventory and change the computer records to agree with what we really have on hand. That's an example that you can relate to. I'm not saying you're a shoplifter. I'm saying that you could imagine happened. Okay? But what about an item breaking or getting too dirty or shop worn that we don't want to sell it? We have to throw it away. There are all sorts of reasons that inventory shrinkage might occur. We need to update the records occasionally. We have to take inventory. For a merchandising concern, it's considered a sound business practice to at least take inventory once a year. So that's perpetual in a nutshell. Let's talk about periodic procedures. When we record the acquisition of goods under periodic procedures, we debit purchases instead of inventory. So there's where it begins. We are not keeping up with the level of inventory all the time. At the time we sell an item, we make 1 entry at the cash register, not 2. We debit accounts receivable and credit sales to record the revenue that we earn, but we make no entry at that time to record this reduction that occurs in inventory. Those goods are still walking out the front door, but we're not accounting for them. And that's where the problem starts. We had the opportunity to account for them at the cash register, and we chose not to. We have to take inventory. We have to physically count all the goods that are there in order to determine cost of goods sold, in order to determine the ones that aren't there. It's an absolute necessity, but it's considered to be a sound business practice for both perpetual and periodic procedures that we take inventory at the end of the year. We have to. It's funny because Mr. Elliott and I were working on a project last Thursday, and I got an email message and shared it with him on the spot and thought it would be worth sharing with you today. It's from an alumna. She's working in industry now, and she wrote me this little short thank you. It says, if there's one simple accounting formula that I use all the time at work, it is beginning inventory plus purchases is goods available for sale. Minus ending inventory is cost of goods sold. Raise your hand if you've ever heard that before. It solves a lot of problems that look more complicated than they really are. Just thought I'd note that. So, there's a little real-world perspective for you. Your efforts in class are not going unrewarded. You'll get the payoff someday to get to use the knowledge you're acquiring. Let's talk about this need for inventory, this importance of inventory, a necessity under both periodic and perpetual procedures. We need a plan. Our goal should be to count every item, to not overlook anything, to not count anything twice, to count every item once. Is that a reasonable goal? Yes or no? Yes. Why take inventory if you don't have this goal? If you just want to do a little hodgepodge count here and there thing, it's not quite going to cut it. We need a systematic plan to follow that would allow us to accomplish this. One of those items in the plan is to establish a good cutoff. Now, in the same way that periodic has been the tradition that perpetual is taking the lead on now, in the old days, we had 9 to 5 kinds of stores, or 9 to 5 Monday through Friday, open until 9 o'clock on Thursday night. Y'all with me here? And we were closed on Sunday, and sometimes closed on Saturday. We had some opportunities to take inventory. I think it's a lot more complicated to establish this idea of cutoff. Where are we going to draw the line and say, these transactions led up to the end of the year and these transactions are in the new year? That's what I mean by cutoff. Most business entities these days are open long hours. Many of them where you and I shop are open 24 hours a day, 7 days a week. When are they going to stop and take inventory? Are you with me right this minute? Yes? This idea of establishing cutoff has become more complicated as the world has become more complicated. One of the things that we sometimes do is another fall break event. I was in Home Depot a couple of times, fall break, and this happened last 12th? Last Tuesday, Wednesday, Thursday, sometime last week. I'm walking down looking for my item. I glanced down this row and I saw this covey of people working and immediately knew what they were doing. What were they doing? They were taking inventory. How timely. And I snapped this picture. These are all contract people. They're in the maroon t-shirts, and they were all in that aisle just counting out the wazoo. Are you with me here? Now, if I'd walk down that aisle and pick something off the shelf, that'd mess things up, but I'm sure they've got a plan for that too. This idea of taking inventory when the store's open is a whole new thing, a whole new problem that we've had to learn how to solve. In the old days, this idea of establishing a proper cutoff, we could solve by closing. Sometimes we would close our doors, and some companies are still doing this, so that we don't have the, pardon the use of the word, aggravation of the customer. Do we typically think of customers as aggravating us? Yes or no? No. Customers are our favorite thing to happen. We want to sell goods to the customer, right? But during the inventory process, the customers are in the way. They're an annoyance just for this little short period of time. So we think about closing our doors. And over the years, I've collected some newspaper ads to share with you this reality of we might close our doors. Johnny Brown ran an ad in the newspaper that says, we'll be closed all day Wednesday for inventory and we'll open on Thursday the 12th with an extra sale. So did they give the employees all the day off and they could all go snow skiing?
No.
Everybody showed up. Hard work, maybe all night long. Wolf Brothers, abbreviated shopping hours at South Roads. We'll be open from 10 till 3 so that all our employees can go see a program at their child's school at 3 o'clock in the afternoon. Yes or no? No? They're staying there and they're counting. Foley says we're closing early today at 7:30 to count inventory all night long. They hope that they can be finished by the time they open the doors the next morning at the regular time. And Sears closes at 6 o'clock and opens at 1 o'clock the next day. Counts all night. All the employees come to work and they count all night long and all morning long and hopefully get to run home and take a shower before they show up at work at 1 o'clock to unlock the front door. Y'all with me or not? And Penny's. Penny stores are going to close Tuesday at 5 o'clock and open Wednesday at noon. They're going to count all night long and sometimes in the morning. We need a good cutoff. And sometimes we close our doors in order to accomplish that cutoff. And we need a plan. And sometimes one of the steps in the plan is to divide up in teams of 2 so that you're assigned particular parts of the store to count and you're given a list of things to find and count. And typically, I was in my TV and here's a team of 2. You see what's going on here? This person's counting and this person's writing down what they counted. How about that? So we also have tags, and I saw some tags, and I should have taken a picture of one, and I didn't think of it in time. But the item that I was trying to buy was covered, the descriptions and the prices were covered with inventory tags. And I finally got somebody to help me, and I hadn't found them yet. She helped me find where they were. And then we had to look under all those tags. That's when I became aware that they were taking inventory, before I saw the other 2 pictures. Y'all with me here? So as they counted them, they put some sort of sticky thing on the shelf so that when the supervisor walks through, oh yeah, this is done. Yeah, I see it. Okay, hop, somebody needs to count this. Y'all with me here? We need a plan. We need to be systematic. We need to be thorough about this. We need to know about when these goods become ours. So let's envision that we all work for the same company. And we have just counted all night long. It's 9 o'clock in the morning or a little past. And one by one we're coming into the employee break room where we're assembling with our computer printout. And this pile of completed ones is growing and growing. And there's a little party going on. And the boss bought donuts. And we're all feeling good that we've got this behind us for another year. And sure enough, we hear the diesel truck, Matt, the truck driver, backing up to our dock. I'm not counting those goods. Are you counting those goods? Y'all with me here? No, he should have been here by 9 o'clock if he wanted me to count those goods. It's after 9 now. I'm not counting those goods. You counting those goods? Well, it's not quite that easy. We need to know more about these goods, and it's the good old shipping terms that you experienced in the 2 prior weeks we've spent together about deciding who pays the freight that also helps us determine when these goods become ours. The question we're trying to answer right this minute is, when does title pass? Do you understand about title? probably the first day in here, when I was explaining the accounting equation to you and I was trying to get you to understand the concept of equity. We talked about your car being stolen and how you would prove that it was your car. And your answer to me was, it has a title. If your name's on the title and you can find that car, the identification number on it's going to say it's your car and not the thief's car. Yes? Well, it's that same concept of ownership that I'm trying to get you to see at the moment. Refresh my memory about who pays the freight when it's FOB shipping point, the buyer or the seller. Say something.
Buyer.
If it's FOB shipping point, the buyer pays the freight. It's as if the buyer sent his own truck. So let's say that I order something from Pennsylvania, FOB shipping point, and they put it on a truck and it left Pennsylvania 2 days ago and didn't get here by 9 o'clock this morning, so I'm not going to count those goods. Are you going to count those goods? It's not quite that easy. When did those goods become ours? At 10 after 9 this morning when they arrived? Or 2 days ago when they were shipped? And the answer is because it was FOB shipping point and I, the buyer, was responsible for paying the freight, it's as if I sent my own truck. When those goods were loaded on the truck, they became mine 2 days ago. Are we going to count those goods? Indeed we are. Those are part of the inventory we're determining. They were ours 2 days ago. Now, what about the goods that I shipped yesterday? I shipped them yesterday, FOB destination. Who pays the freight when it's FOB destination? Refresh my memory. The seller pays the freight. I pay the freight. I sent these goods to California 2 days ago. Now, there's really two lessons here that really boil into one, but I'm going to try to distract you from inventory to get you to see the practicality of this, that you could figure it out and remember it. We just received word that last night in the desert on the way to California, this truck driver had a wreck, rolled the truck. He was thrown free and not harmed at all. Praise the Lord. But the truck caught fire in the desert and burned, and everything there was destroyed. Whose insurance company shall we call? The buyer's or ours? Whose goods are those? Those goods are ours. We're going to look to our insurance company for reimbursement. Now, I was hoping that you learned something here that you could apply here. Who pays the freight when it's FOB destination? Say it again.
Seller.
We do. Those goods are our goods until they arrive. Now, there wasn't really a wreck in the desert and the goods really weren't destroyed. I just made that up. I hope you figured that out. Here's the second part of that example. Here's part B. No wreck in the desert. These goods are on their way to California to our customer's place of business. And they're not there yet. At 9 o'clock this morning, they were out in the desert in Arizona someplace. Are we counting those goods or ignoring those goods? Those goods were ours until they arrive. We have to count them. They were still ours at 9 o'clock this morning. Even though they're on a truck, they're on our truck, and we're paying the freight. You should know two things about FOB shipping point and FOB destination. You need to know who pays the freight. And you need to know when title passes. When do they become the property of the other party involved in this exchange? That helps us with inventory. That helps us with this good cutoff. Inventory is so important to us. Let me name a few reasons. It's really important that this count be right, accurate, for lots of reasons. Because it's the reason we're in business. It's the most active element of anything else on the financial statements. There's more activity with inventory than anything. It's our principal source of revenue. It's the reason we're in business. I already said that, but it's worth repeating. This is how we make our livelihood. It's revenue. If we look on the balance sheet, it's generally the largest current asset. we've got more money tied up in this than anything else, probably. And on the income statement, it directly affects the largest reduction from revenue, that being cost of goods sold. The determination of inventory is extremely important. We need to get it right. Inventory is important. Beginning inventory plus purchases is goods available for sale. Goods available for sale minus ending inventory. There it is again. Ending inventory is important because it affects both financial statements. The amount in that yellow box is the amount that's going to be merchandise inventory on the balance sheet. The amount of that yellow box determines the remaining size of the rest of the box. And it's the rest of the box that's cost of goods sold that gets reported on the income statement. If we miss the determination of the size of that yellow box, we mess up both financial statements. It's extremely important that we enter into this process of taking inventory seriously and that we want to get the right answers. The book probably does a better job in an illustration than I can do in just a moment or two, but I wanted to call your attention to what happens if you mess it up. Look at the book's example and follow through with this, knowing this already. If you understate inventory, net income, assets, and capital will all be understated. You've messed up both financial statements. Now, it doesn't take a rocket scientist to realize that if you overstate inventory, net income, assets, and capital will all be overstated. If you mess up inventory, you're messing up both financial statements this year. But if ending inventory is the number that's wrong, at the stroke of midnight on the last day of the year, ending inventory becomes beginning inventory. And you're going to mess up next year too. It's 2 years impact getting it wrong. That's what? 10 minutes of the importance of inventory? Determining inventory is really, really important. Now, I'm going to continue the example I began. So our deadline was 9 o'clock this morning, and we were bringing in stacks and stacks and stacks of completed lists. And breathing this sigh of relief, looking back, being thankful that we've completed this task this year and we don't have to do it for another year. But we think of counting the inventory as being the completion of the project. Do we want to know the number of units we have on hand? Only as a step in getting to the final number. Some way, somehow, we've got to convert this stack of units into dollars. Some way we've got to look up every item in the inventory and see what we paid for it. And there are drawers and drawers and drawers full of invoices. And they're filed in some systematic way, hopefully. And we need to know which invoice to look upon to find the cost that's to be assigned to these units that we've accounted. There are several ways we can do this. We need to choose one of these arbitrary assumptions about the way we're going to allocate these costs to the product. Now, I may confuse you in the next moment or two, and it's not deliberate. I'm going to use an illustration of how we actually stock the shelves. But I would need to remind you at the beginning and remind you at the end, it's not about how we stock the shelves. It's how we assign costs to these units that we've counted in ending inventory. Which invoice will we use to assign the cost? Let's talk about how we might stock the shelves. The goods may actually flow in the order that the expenditures were made. This one has a nickname. This one is considered to be the first item that we buy, is considered to be, assumed to be, the first item we sell in the order that the expenditures were made. We call this one first in, first out. First in, first out is so commonly known that we don't call it first in, first out in the real world. We call it FIFO. FIFO stands for first in, first out. Can you name me an industry in which the shelves in the store or the products that they deal with actually flow FIFO? Name me 2 or 3 or 4. Come on, quick answers. Don't let us miss out on something at the end because we take too long.
Fresh produce.
Fresh produce in the grocery store is moved FIFO. Name one.
Restaurants.
Restaurants use FIFO. Everybody gets fresh food that way. Name one.
Dairy.
A dairy ships goods FIFO. Name one, somebody. Canned foods. Not so important as the other 3 named, but probably. FIFO. How about an automobile dealership? Ever heard the plea, oh, we've got to get rid of this stock, the new cars are coming in, we've got to get rid of these? Yes or no? Got to sell last year's so that there's room for the new models to come in. How about clothing? For 2 reasons. The seasons. Can you buy bikinis right now at the mall? Not very easily. Not a very good stock of bikinis at the moment. Yes? Can you buy leather coats in July at the stores in the mall? Not very easily. Maybe if you try real hard, but they probably only got 3 or 4 to choose from. Yes or no? The seasons and styles. They don't want to keep a bunch of old stuff around that you're not interested in buying once that's out of style. They're afraid it'll go out of style and they won't be able to sell it, so they keep moving the goods as they come in. They want them moving out the door so they can buy more. That's FIFO. How about in the reverse order in which expenditures were made? This is arbitrary. It's an assumption. But I'm trying to talk about the practicality of stocking the shelves. This one's a whole lot harder to think of. So I'm going to make up an example. Let's pretend that I was working in the garden at home and noticed I've got a lot of clay, soil, a lot of flowers that aren't doing very well, and went to the nurseryman and he said, you know what you need to do is work some aged sand into your dirt. Really till it up and put some extra sand in there. There's a sand mining operation over just across the bridge on the way to Jinx, and they take it out of the river and they've got this huge pile of sand. Get you some of that aged sand and work it in with your dirt that you've already got there and see if it won't loosen it up some and your flowers will grow better next summer. So this weekend, I've already talked to my son about borrowing his pickup. Yeah, that's a pickup. Some days it looks better than that, some days it doesn't. And I'm going to back it up to that sand over near the Arkansas River in Jinx and say the same story I just told you. My nurseryman says if I give some of that aged sand, I want some of this. They going to give me some of this? Yes or no? Hello? Are they going to move the whole pile to give me some of this aged sand? Yes or no? No. I think they're going to take a hunk of this and put it in my truck and take a little more of this and put it in my truck and take a little of this and put it in my truck. Which sand am I getting? I'm getting the last in. This one's called LIFO. Last in, first out. Now, real industries that stock their shelves LIFO are harder to come up with, harder to imagine. But we could account for them in really the purpose of this if we wanted to. There are 3 ways: FIFO, LIFO, and average. The average of the expenditures. Now, for periodic, we're going to talk about all 3. You need to pay attention to the syllabus. For perpetual, I'm going to talk about 2, not average for perpetual. In one of your homework problems in the syllabus, it says you may omit a certain step. And that's the one, average for perpetual. But don't miss the point. Most of this discussion was about how to stock the shelves. At the beginning and now at the end, I'm repeating. It's not about how to stock the shelves. It's how to assign cost to these units that we've counted. Part of the process is to count the goods. Close your doors. Divide up in teams of 2. Count everything once. Meet the deadline. We've got to open the doors and get the customers back in here buying stuff. But now we've got to look at these units and convert them to dollars. We've got to look at an invoice in the drawer. Are we going to look at the invoices in the drawer in a systematic fashion that would assume the first good in was gone and the last good in is the one assigned to inventory, FIFO? Or are we going to assign the cost to inventory, LIFO? The last good in, the most recent purchase is assigned to inventory. If any goods remain, they're the oldest ones, the invoice is at the front of the file drawer. Or are we going to add them all up and divide by all of them and get an average? We can do any of those. If you hear nothing but this today, hear this. Any industry can use any assumption. Grocery stores can use FIFO, LIFO, or average. Sand mining operations can use FIFO, LIFO, or average. I forgot to name an average one. An example, a gasoline station has the gasoline pumped into the underground tank and it averages with what's there, right? And a gasoline station can use FIFO, LIFO, or average. There is no rule that says you have to stock the shelves the same way that you assign the cost to inventory. There is no rule. Did you hear? There is no rule that says your method of stocking the shelves and your method of assigning cost to inventory have to be the same. There is no such rule. Read the heading of this one more time. Arbitrary. Assumption. Those words are meant to leap off the page and remind you any industry can use FIFO, LIFO, or average. Any industry has the choice of assigning cost to inventory. But when we're faced with methods like this, what's the key word in administering them? Consistency. Don't flip-flop. Don't use FIFO one year and LIFO the next. And FIFO the next and average the next. That's going to mess everything up. Pick a method, and unless there's a really good reason to switch, stick with that method. Are y'all with me or not? Yes or no? FIFO, LIFO, and average. We need to know about. We need to know about the impact of our choice, FIFO, LIFO, or average. If prices stay the same, we don't need methods because they'll all give the same answer. Do prices stay the same? Hello?
No.
Prices change. In my lifetime and before, we have experienced nothing but a period of inflation. Let's talk about the general idea. I'm going to do 2 things with these financial statements. You can choose which one of them you want to write down. FIFO says, here's the timeline from the top, that the first good in, the oldest item, is the first good out. FIFO says that whatever we acquired first is going to cost of goods sold on the income statement. And when we start looking for goods that we have left over, we're going to look at the end of the line. Those goods at the end of the line, the ones that we bought recently, are going to the balance sheet, ending inventory, merchandise inventory on the balance sheet is comprised of the recent items we've acquired. FIFO. LIFO says that the last goods in were the first goods assumed to be sold. The cost of those is assigned to cost of goods sold on the income statement. If any goods remain, they're the oldest ones. Way back at the beginning, the oldest items are assigned to merchandise inventory on the balance sheet. They are the extremes, the opposites. Average is always going to be someplace in the middle, as you would expect. What if prices rise? So I've drawn a little inflationary period on the timeline to help us see the impact of us choosing the method that we do. What would happen to the financial statements? Ending inventory on the balance sheet, merchandise inventory. Cost of goods sold and therefore net income on the income statement would be affected how? By our choice to pick FIFO or LIFO. Well, let's talk about this period of rising prices. If we choose FIFO, merchandise inventory will be higher than it would have been had we chosen LIFO. Now, I'm telling you this, and perhaps you're accepting it or thinking about it, but before the week's over, I'd like for you to see the logic and be able to say this back. So let's think about whether or not this is true. Here's the period of rising prices. FIFO says the first good, the low-priced item, is the first out. It's gone. It's part of cost of goods sold. If any goods remain, they're at the end of the timeline. They cost more. FIFO gives you higher ending inventory on the balance sheet and therefore lower cost of goods sold. These are the two extremes. Every item that you acquired, every item of goods available for sale has to show up on the financial statement someplace. It's either on hand or sold. If it's on hand, it's higher priced under FIFO. If it was sold, it's the low price items that are being associated with cost of goods sold on the income statement. Now, if cost of goods sold is smaller, sales is going to be the same, expenses are going to be the same, I'm just changing cost of goods sold. If cost of goods sold is smaller, gross profit is going to be higher. If gross profit is higher, net income is going to be higher. Net income will be higher under FIFO than it will under LIFO. Now, I've mentioned several times, and you've caught on, I hope, to LIFO and FIFO being the opposites. If you can determine one of these correctly, you should be able to reason through the others. When I push the button in a minute, they're all going to be the opposite of what these are. But let's think about it fresh and hear the explanation. Maybe the explanation that didn't make sense the first time will make sense this time. Let's think about the impact of choosing FIFO or LIFO on the balance sheet presentation. LIFO says the latest item goes to cost of goods sold. The old items, the lower priced items, are on the balance sheet as ending inventory. LIFO ending inventory will be smaller than FIFO in a period of rising prices. If inventory is smaller because it came from the first items, then cost of goods sold, the latest items, is going to be higher under LIFO than under FIFO. If cost of goods sold is higher, gross profit will be lower. This decision won't affect the expenses. The expenses will be the same. Subtracting the same amount of expenses from a smaller gross profit gives a lower net income. I'd like you to know that. Think about it. Prove to yourself it's true. In the 70s and 80s, when I was practicing public accounting, we had lots of clients that switched their inventory technique from FIFO to LIFO. LIFO gives lower net income and therefore lower taxable income in a period of rising prices. You have to understand that in that period of time, the annual inflation was 18, 19, sometimes 20%. Do you know what inflation's been lately? 3%, 4%. And we're thankful for that. That's a good thing, okay? But when inflation was high, the cost of things, the prices were going up tremendously. And it was a wise business decision to switch from FIFO to LIFO to get lower net income on the tax return, to defer the payment of tax to the future. It was good strategy. Because I experienced that, it's easier for me to remember that LIFO gives lower net income. Did you hear the L? Remember when you didn't know your left hand from your right hand in kindergarten and your kindergarten teacher said, which one makes an L? LIFO gives lower balance sheet presentation and lower net income in a period of rising prices. And usually by now somebody raises their hand and says, is what happens in a period of declining prices. And it's all the opposite. But have we ever experienced that? Sure, we should know that conceptually, but this is the one that we've encountered the most. Every lecture you've participated in until this moment ends with an example. And this is the first time I've got 5 minutes, but I don't have time to finish an example with you. So one of the things I did fall break was make a video of it, okay? I'm working a handout, an exercise on a video that I'm encouraging you to watch before you do your first homework assignment. It's the demonstration of what I just talked to you conceptually about. This lecture was more conceptual than usual and doesn't have the practical flavor that usually comes at the end. That practical flavor is in I think it's about 25 minutes, little video that I would encourage you to watch. And have a great day and a great week.
God is good.